graciously this morning to this platform, Bethesda Group of Schools e-learning portal, on the subject economics, and we are taking continuation from the important topic, elementary theory of income determination. Elementary theory of income determination happens to be an important topic that crosses secondary to higher institution economics, macroeconomics. Now, last time on this topic, we talked about the circular flow of income, and that explains how income flows from the factor market to the normal household, at our savings market, how income moves from flows from the household to the productive centers or the industries or the factories, and then back to the household, and all of that. How factors are given over to productive centers, as productive centers pays for such factors, which goes to the household, with which those ones use the household rather use to buy whatever goods or whatever meets the needs. I went ahead talking about all of that in detail, talking about savings, talking about the savings is the part of income that is not spent, and we talk about consumption. That consumption is a part of income that is used up, that is not kept. And now today we want to talk about propensities. Propensities. First, we are starting with propensity to consume. Propensity to consume, if you don't mind, in a simple language means tendency to consume. In economics, virtually everything is subjected to scientific approach. In other words, we try to solve everything. They are all calculable, we can solve them. Now, how do we know? The reason for that is to determine the line that government will take in the national development. Everything has to be tested. So how do we do that? How is it done on the national scale, economically? Now, propensity to consume, I've said, talks about tendency to consume. Now, the tendency to consume, in it rather, we will see it in two broad aspects. That is the average propensity to consume, and number two, the marginal propensity to consume. The average tendency to consume, or average propensity to consume, and then the marginal tendency or propensity to consume. Now, the average propensity to consume, this one talks about the proportion of the national income, the proportion of the national income that is consumed, all in the ratio, in pari passu, put side by side with the total income of the nation. The proportion of the national income that is consumed, side by side with the total income earned in the nation. And it is in the formula of total national consumption all over total national income. Total national consumption all over total national income, which in a calculative symbol we use C over Y to represent what we just said, that the proportion of the national income that is consumed. For instance, a question like this is how we apply it, the formula. A question like this is given: if the total national income is 20 million naira and the total national consumption is 5 million naira, the question is calculate the APC, which is average propensity to consume. How do you calculate it? We just import the formula, which is total national consumption all over total national income. In which case, when we adopt this now, we're going to have the total national income is 20 million. We say APC is equal to 20 million all over the total national income, which is, the total national consumption, which is 5 million over total national income, which is 20 million. Then when you do the calculation, you are going to have somewhere around 0.4. So that is going to give you 0.4. This is the average propensity to consume. Now, with this figure, the lawmakers, the economic analysts, national economic analysis, analysts rather, are able to understand what this means. Understand or remember your concept of inelasticity, less than one, and all the implication it has on the national economy. So with that, planning for the nation is carried out, is made available, and then the next line of action to be taken in the national development is arrived at. Now, the next is marginal propensity to consume. The marginal propensity to consume, MPC. This talk about the relationship between change in income and change in consumption. The relationship between change in income and change in consumption. It shows the extent to which the level of consumption changes as a result of a change in income. And then it shows, therefore, the proportion any addition to income which is used for consumption. And it is calculated with this formula, changes in consumption over change in income. For instance, you are given this formula, or rather this question. If the monthly income of an individual increases from 10,000 naira to 15,000 naira, and his level of consumption increases from 4,000 naira to 6,000 naira, the question therefore is calculate the marginal propensity to consume. Calculate the marginal propensity to consume. Now, change in consumption all over change in income. Look at the question. The monthly income of an individual, income increases from 10,000 to 15,000 naira. The change in this income is 5,000 naira. While the change in consumption is 2,000 naira. Therefore, MPC, marginal propensity to consume, is a change in consumption all over change in income, which is equals to 2,000 all over 5,000. If the income increases from 10,000 to 15,000, the difference there is 15,000 minus 10,000. That is the change in income. That is 5,000 naira, and then his level of consumption increases from 4,000 to 6,000. The difference in it is 6,000 minus 4,000, which is 2,000. Change in consumption over change in income. When you do this calculation, you are going to arrive at decimal. I think this should be around 0.4 also. This is around 0.4 also, coincidentally. So this is the marginal propensity. This is the marginal propensity to consume. These items are applied. Now let's rush to the propensities to save. Propensities to save, the tendency to save. We can also see it in two aspects: average propensity to save and marginal propensity to save. The average propensity to save. Now, we can subject it to mathematical analysis and mathematical workings. It is simply total national savings all over total national income, which means S over Y, where S represents total national savings and then Y represents total national income. Note this very well, that average propensity to consume, rather average propensity to save, increases when income increases. Of course, you know when income goes up, savings can also likely go up. So have that, and then also have this at the back of your mind as a constant, that average propensity to save plus average propensity to consume, when you put together, must be equal to 1. Anything else means you are wrong. So average propensity to save and plus average propensity to consume always equals 1. Now, marginal propensity to save, on the other hand, measures the relationship between changes in the level of savings. It measures the relationship between changes in the level of savings and changes in income. And therefore, it shows the changes in savings that is brought about by a change in income level. Therefore, marginal propensity to save is change in savings all over change in income. Whenever a question is given to you, quickly look at, they will always give you savings. They will give you the income. If you are to calculate marginal propensity to save, all you need to do quickly is to get the difference, minus the difference between the savings that have been before and the savings, the previous savings of the individual or country or group, and then the present savings of the individual. Then change in income, get the difference, minus the previous income from the present income. That will give you the income, and then subject it to the formula, changes in savings over change in income. Whatever you arrive at, that becomes your question. That becomes your question. Look at, for example, if a firm earns annual income of 80 million naira and spends 50 million naira to buy machines, calculate the average propensity to save. Calculate the average propensity to save of the firm. The average propensity to save is total national savings all over total national income. The total savings all over the total income. Just go about the formula, that will be it. Now, before we go, equilibrium level of income. Equilibrium level of income. This may be defined as a situation where the total amount of people, this is rather, that can be defined as a situation where the total amount the people wish to save equals to the total investment of the business unit. The total amount of money the people wish to the total amount of investment the people intend to make. Now, he talks about a point at which total savings equals total investment. The word aggregate means total. So, at the point at which savings equals investment, that is equilibrium level of income. And then, at equilibrium level of income, there is a balance between demand and supply. And then you observe that there will be no tendency in the economy or in the company to alter or to change the output. For equilibrium national income to be maintained, total savings, what I'm saying is that must be equal to the total value of investment on goods and total expenditure. Okay? For equilibrium national income to be maintained, savings must be equal to investment on goods, and aggregate expenditure must be equal to total output in terms of the productive sectors now. So income earners, which are the households, can spend their income on consumable goods or services. So that means income, which is represented with Y, is equal to consumption plus savings. Income is equal to consumption plus savings. While firms can produce either consumable goods or investment goods, in which case, as it concerns the firms, income is equal to consumption plus investment. While for the household, income is sent here as consumption plus savings. For the firm, income is equal to consumption plus investment. This is the little you can take for now, but before we go, you take this as practice exercise. If the daily income of factory workers increases from 500 naira to 700 naira, and the factory worker, okay, increased its level of consumption by 80 naira, calculate the marginal propensity to save and to consume. Calculate the marginal propensity to save and to consume. This is the little you can take for now. Please ensure you solve this question. They are past SSC questions. This is the little you can take for now. Until next time I meet on this platform, thank you for giving audience.